Hello, I'm Pat Roberts, the Managing Director of LNG Worldwide Consulting, and I'm producing this podcast in collaboration with the World LNG and Gas series. And my theme this week is centered around rising temperatures, rising prices, and inevitably rising concerns. And I'm going to plunge straight into short-term dynamics because that's where most of the headlines are this week. There have been sustained heat waves in Europe and North Asia, stoking gas demand and pushing TTF prices up this week to an all-time high. And it's based on concerning supply-demand trends rather than a single spike due to a specific action. Asian buyers too are out in the market buying spot gas, both on the prompt and also gas to store up for winter demand. If I do a quick check, as at Thursday the 18th of August, TTF October prices are $68.95 per MMBTU. JKM is at $56.60. That's 3 times higher than JKM was a year ago. And what's concerning is the short-term supply demand of energy overall. It's not just gas. And let me give you some context. Norway has exported less gas due to scheduled maintenance in August, but also the Norwegian government has set out now formally how it will prioritise the supply of its electricity to its domestic market over exports. And that's further squeezed countries like Germany, Netherlands and the UK in terms of electricity imports. Hydroelectricity output is 20% down in Europe based on summer droughts, and navigating the River Rhine in Germany has become difficult for barges due to low water levels, and it's prevented some coal deliveries getting to German power plants. And to cap it all off, EU wind power is also down at least a few percentage points on the European summer average. Put that all together and you get real supply-demand concerns for energy overall. On the gas markets, the rough storage in the UK looks like it now will reopen and will create about 3 BCM of new gas injection demand. And a new trend that I mentioned to you a week ago is that gas traders are focusing on the curve beyond month +6 in order to try and buy up cheaper contracts, as many seem to believe that these high prices are here to stay. So liquidity has actually increased further out down the curve, and now we're seeing that all prices are up. And prices are actually over $62 per MMBTU all the way through to summer 2023. The top line from many traders is the TTF market is broken. It's got runaway bullish prices for winter 2022 on the concerns that supply may tighten. And the very smallest piece of news on supply concerns results in a price spike and volatility. And it's not just the prompt months that rises. Summer 2023 gas is now trading at well over 50% higher than it did at the start of July. For traders who are looking to hedge, liquidity has gone right down. Traders are having to put up 80% of the value of the gas contract as the margin call alone. This is pushing several out of the market to accept no trading activities or unhedged trading, which in turn is driving down liquidity, and that in turn pushes up volatility and raises the rise of possible price spikes. As some traders say, they're in a market at the moment with no logic. Now, as I'm recording this, I can actually hear the physical rumble of thunder outside, but it's going to take a lot of rain to cool down these markets. Meanwhile, on the oil side, there's a potentially different story of what looks to be potentially an emerging supply surplus over the next few months. Demand is falling, and there have been some safety valves which are available to producers should they have any need to increase oil supply. And that should happen, of course, if there's a demand rise from China. Brent October this week has been trading at around $91, and some traders have revised their views now to a sub $100 barrel for the rest of the year. Obviously, for oil index term LNG contracts, that means an average price of around $14 delivered ex ship, which all looks very, very cheap compared to spot prices right now. So that's my scene setter, a really difficult spot market at the moment. But let's work our way now through some of the weekly news from macro through to micro. And if I go up to the macro level of news, it is really centred this week around the price caps that are going to apply for gas and will soon be announced throughout the European markets. In some countries like the UK, inflation was reported as now over 10%. And this week, the German price cap for gas actually was announced by Germany's economy minister. He has confirmed a 2.4 cent per kilowatt hour levy to be charged on domestic gas consumers from October the 1st, blaming the artificial gas supply shortage at the 55 BCMA Nord Stream 1. And that, he says, is arising from Gazprom's sustained curtailments, which have taken gas flows to new lows. The gas supply surcharge will remain in force until April the 1st, 2024, but it can be increased or decreased at 3 monthly intervals, depending on the actual cost estimate of German gas imports. Gas importers can now claim revenue from the surcharge to cover 90% of what they paid to replace undelivered Russian pipeline gas with spot volumes. And claims for Russian gas substitutions have already been submitted by 12 companies already. And it's costed at around 34 billion euros through to April 2024. Moving on now to news from big companies, New Fortress Energy and global asset manager Apollo have completed a $2 billion joint venture agreement to create Energos infrastructure. It's going to have a portfolio of 11 LNG infrastructure vessels, which are 6 FSRUs, 3 FSUs, and 2 LNG carriers, 10 of which have all now been chartered to Energos for up to 20 years. Energos will be owned 80% by the funds managed by Apollo and 20% by New Fortress Energy. On now to LNG stats and trends, and I can't help but come back to TTF again. Natural gas futures contracts at the Dutch TTF hub soared this week, and as the summer heatwave continues and Russian gas supply remains suppressed, we have record slumps in the amount of gas coming to Europe. It's down to 3.6 BCM in July from Russia, and that is down 23% from the previous record low set in June. Moscow continues to ramp up its economic pressure on Western leaders to make concessions in the Ukraine war. But really, we're looking at much less liquidity in the TTF range of month to month plus 6, and more liquidity is now appearing in later years down the curve, like years 2 to 5. And it creates some new opportunities if you can believe you can read the sentiment in the market. But many traders are saying there's a real definite requirement for a seaborne LNG price for Northwest Europe, and some type of future contract is becoming apparent. Because who can manage a $15 per MMBTU basis differential between TTF pipe gas and LNG cargoes physically landing in Europe and looking for a regas slot? As I've mentioned before on previous podcasts, there are wide spreads also between MBP and TTF, as there are still physical constraints which are stopping the free flow of gas from the UK to continental Europe. So one of the things to look out for is potentially some new marker price for LNG into Europe. Moving now to prospective supply projects, and it was announced this week by BP that the Tangguh Train 3, a 3.8 MTPA expansion in Indonesia, is now expected to start up in 2023. It's been severely delayed. If I look back at my notes, the financing for Train 3 was actually announced in 2016, some 6 years ago. Frankly, the sooner the better to help manage the supply-demand global balance for LNG. So we wish this project well. 75% of the volumes produced will go to PLN Indonesia Power Company, and the balance will go to Kansai Electric. Now on to LNG demand, and the news of the week was the German government who signed an MOU with Uniper, RWE, EnBW and VNG for supplying LNG to the Wilhelmshaven and Brunsbüttel FSRUs from this winter, and looking for a period of supply right the way through to March 2024. When these two FSRUs are up and fully operational, they'll produce something like 13.5 BCMA of capacity. Short-term dynamics, just to wind off the week, we see here in the news a physical cargo coming from the Northwest Shelf in Western Australia to the UK, which is a very unusual activity. It just shows you the lengths that traders will go to get gas into Europe. And Prelude remains offline in Australia until at least the 1st of September due to industrial action. Rounding off the spot prices of the ones I've already given you for TTF, JKM and Brent, let's look at Henry Hub, which for October has gone up in the week to $9.20, and spot vessels shot up quite a lot. 174,000 cube vessel spot now is in the range $92 to $120,000 per day. Overall, the outlook is particularly nervous and bullish. And I leave you with a couple of thoughts. The first is that the greenest energy is the energy that we don't use. It's a message loud and clear for all of us to conserve energy. And my last point is that if you have enjoyed this episode, we would invite you to rate it, to review it, and to subscribe to our LNG Wrap, because we really appreciate that, and it will help others find us too on social media. Thank you very much for listening, and hope you enjoyed this week's edition. Join me next week for another edition of the LNG Wrap. Thank you and goodbye.